I want to talk oil and gas now. Obviously, a huge subject, especially in terms of your performance of your portfolio. I mean, you want to have been involved in these, and that's why I'm pleased to get Schachter Energy Reports. Of course, he's the author, Josef Schachter. Josef, thanks for taking time with us. And as usual, especially in this file, there's no shortage of things to talk about. So I'm going to start with just a real broad-based question, like. I want to talk about the geopolitical impact on oil prices. Where do you have a broader perspective on those prices?
Well, the first thing, we've had a fabulous run in the sector. We were under $70 at the beginning of the
Mm-hmm.
year. We got up to 88, 87, 67 during, after the battles in Gaza and with Hamas and Israel, and the concern that Iran, would get involved after, the attacks there, shooting down all of their missiles and drones, which the Americans and others were involved in, and British and others were helping. We're now about 79 and a half. And we've come down because inventories are building. It's normally at this time of the season, after winter, you have a shoulder season, and then things pick up again for the summer driving season. So if you have 102 million barrels for the year on average, you'll have 103, 104 in winter. You'll have maybe 98, 99 in the shoulder season of the spring, same in the fall. And then winter of 24, 25, we'll get back to 103, 104, and then grow in 2025. And the key thing people have to realize is the U.S. is showing some growth in demand, about 0.4%, so a couple 100,000 barrels a day. The one we've got to be keeping an eye on is China and see when they get their economy together, but they're not. Exports have been a problem. Manufacturing has been a problem. Consumer issues have been a problem because of the real estate disaster in the country. The right now is probably a $5 war premium still because of what's going on in Israel and Hamas. So if you look at the pricing, we think we're going to go below 75 during the shoulder season. But once we get into the summer driving season, I think we're going to start seeing that price rise come again. We're very bullish on the sector longer term. I think we'll see $90 WTI during Q4. I think we're going to see in 2025, we'll peak through 100. So people should look at any time there's a pullback in the sector and buy, because we have stocks that are up 50, 60% from the lows at the beginning of the year. Some of them have pulled back. There's great bargains in the energy service sector. The natural gas stocks are doing well. The surprise for natural gas is it was trading at $1.50 in April, and we're 260 today, up a dime. So we're beginning to see that the storage is not building. U.S. LNG exports are picking up. And in the fourth quarter of this year, Coastal GasLine is going to get filled with natural gas, and that's going to help the Canadian sector. So the bargains in the Canadian natural gas sector are very, very attractive for people. And we've been focusing on both the energy service because the drilling activity, fracking activity will pick up. Northeast BC will be humming in the fourth quarter, and then 25, 26 on to fill LNG Canada, maybe LNG Canada 2. Cedars is moving forward with Pembina, June decision for FID there. So there's a lot of potential on the West Coast. You and I were talking about this 10 years ago, and it's only finally now becoming a reality. But the Canadian natural gas sector has a lot going for it. We've seen heavy oil do well, and drilling in Canada has picked up for heavy oil to fill the TMX pipeline. The surprise, though, is there's an issue with fluids. There's an issue there's enough tugs to move the boats in and out. And the most recent one is they can't bring big ships in. So they're taking smaller ships and then taking them offshore and then loading into large fruit carriers to take it to Asia or down to California. So there's a little bit of growing pains with this and maybe a little bit of lack of planning to make this thing go. And of course, the government of Canada is going to have to write off quite a bit of TMX, just like we saw TransCanada write off a lot of coastal before the First Nations and others will want to come in and be the buyers and owners of those projects.
There's several things you've said there. I want to come back just for a sec. Short term, long term. Long term, you're still very bullish on it, and I'll reiterate what you said: is that you take these dips as buying opportunities but bottom line is oil prices. The pressure is upwards, and I'm talking as we go out 2 years and 3 years and 4 years.
Yeah, I think that people need to take into account that commodities have not had a sufficient amount of investment. Look at copper prices. Copper prices were, $3.60. They're over $5 a pound now. We're seeing nickel prices move. Aluminum prices. We saw some even, commodities that we consume. We saw cocoa go up, we saw coffee go up. They're backing off a little bit now, but they have fabulous runs. So I think the basic raw material inflation is there. You saw today a report from the IEA saying that there's a shortage of critical minerals,
Yeah.
and that it was, a major report saying we need to spend money on investing if we want to have more solar, more renewable, more wind power, more EVs. A lot of money is going to have to be spent, and those countries are going to want a higher quality of life. They're going to want to have nice housing. They're going to want to have
Yeah.
electronic appliances. They want to have their own cars. They want to have, electricity 24 hours a day if they want it. So that is going to require a lot of money to be spent. And all of these raw materials, I'm not a mining person, but the argument of shortages in copper and aluminum, nickel are very clear. Just like I think when you realize we're not spending enough money replacing the decline rate in oil and natural gas, and a major cycle is ahead of us as we try to get China and India to not build as many coal-fired plants as they're doing for electricity, and convert to natural gas, as it becomes available. And of course, the big thing, everybody, is data centers. The demand for electricity, and also replacing and repairing and strengthening the grid is going to require a lot of copper, and of course is going to consume a lot of electricity. And I think if we want to see EVs as the governments want in 2030, 2035, the systems are not there in place, and a massive capital investment in raw materials and then the building out is going to be important. And that's why the natural gas to me is of the two is the more favorite commodity for me, because I think you get to $5-6 ACO by the end of the decade. That's going to, even if costs go up, which they will for drilling and fracking and pipelines, and tariffs on lines will go up, the margin will be significant, as we saw during 2022. We saw some very high prices then, and big cash flows for the industry. And I think people should look back to that and say, okay, we get back to $5-6 gas. What's that going to mean to companies? And I think they'll be shocked how profitable the industry will be.
Let's talk about Canada versus the US in terms of companies. Of course, you're looking at everything, but I would think that the TMX pipeline, for example, would be good news because finally our oil producers are getting a higher price. They don't have that big Canada Select discount anymore. And again, I'm not working in this the way you are, but it would seem to me that would be a positive. I think the number I saw, we're sending about 890,000 barrels a day down. They get on average $9 more. Well, that's got to translate to the bottom line for some of our Canadian producers.
Yeah, there's two things about this. Is the TMX is moving more oil. It can handle 890,000. I don't think they're getting there every day because they're still concerned by the producers about what the tariffs are going to be, and there's some dialogue going on there. And so I don't think we're getting the full use. And then the takeaway from the BC coast is an issue, as we talked about just a few minutes ago. But the key thing is we've gone from $15, $16 differentials to $11, $12 differentials. All of that goes to the bottom line. But the big win for the industry is the Canadian dollar. Instead of a par parity dollar, which we had, a decade or so ago, we're now sitting at 73 cents. So you multiply 1.37 times that $79.50, and that is big coin for the industry. And that's why the cash flows for the oily focused companies have been very, very strong, even though they're down from a year ago, but they're still quite strong. The natural gas companies, if they hedge properly, are having decent numbers. Those that didn't are showing weaker comparisons. But the key thing is by Q4, and if you look at the forward curve into next year, companies are hedging at 310 and 320 ACO per MCF. And if your input costs are $1.10, $1.20, that's a pretty good margin in anybody's business.
And again, this is by nature, it's oversimplification, but, so if somebody was coming in, they say, I want to get involved in this sector as an investor, I want to make, so you would, am I right in assuming that you would recommend looking at the Canadian companies before you'd look internationally or, US in particular, because of that kind of a discount, the 40% discount, with that 73-cent dollar for our operators?
Yeah, and the Canadian companies are cheaper than the Americans because they've not been attractive. The political side here, people are concerned about a little bit, but security of supply the reserve basins and the quality of our basin, the Montney, the Duvernay, the oil sands. We have a fabulous asset here that if we had the right political attitude
Hmm.
and approach to the industry, we could be a fabulous generator of wealth for the country, for the federal government, for the provincial governments, and for the people working in the industry and the economies of where like Alberta as a whole, even though oil sands are in Fort Mac and Montney is in northwest Alberta, it's going to generate a tremendous amount of wealth because the G&G, the geology, geophysics, the finance, the heart of that is Calgary. The manufacturing ability to grow the oil sands and stuff is in Edmonton. The government's based in Edmonton. Red Deer is a big win. Grande Prairie is a big win. So we could see tremendous wealth effect in Alberta. And then again, Northeast BC is going to be a juggernaut because that's where the companies are grabbing land and drilling, dealing with the First Nation issues, getting those resolved, getting them on site, and getting them to have industries and have the staff trained so that they can work with the industry, so they have a wealth effect for the First Nations communities. And we're seeing that happen. And more companies are working with them. And remember, there was the blueberry issue for one of the First Nations in
Yep.
Northeast BC. That's resolved. Land issues, drilling licenses are being approved, and more activities going there. And the industry is now putting in pipelines so that the natural gas can go to the West Coast, but the liquids, the natural gas
Yep.
liquids, can be moved to the Fort Saskatchewan area where they're then mixed with the heavy crude so that you can move it through the pipelines.
Yeah, let's talk about specific stocks for a second. Now, you're at the World Outlook Conference, of course, and the portfolio you put forward there has done extremely well. With some real stars in it. But again, people always want to know, what have you done for me lately? Yeah, and I might say, by the way, one of the measures I would use to the success here, not just of Schachter Energy Report, but I mean, I'm talking the industry, is that how your company is growing. That there's so many positions to look at, there's so much detail to review, et cetera. And I just, I find that, a great bellwether of, that this is hot. Alberta's hot. Schachter Energy Report's hot. More people working in that business. And let's talk a little bit about, again, I don't want you to give away the barn here, but give me a couple of examples that sort of fit the narrative that you're sharing with us today.
Yeah, we've been focusing on the natural gas side. So Paramount, Birchcliff, there's a large number of names, Pine Cliff. There's been a large number of names that we like that are covered. And we have a section now in our reports we call Top Picks Now,
Yeah.
which we just started this year because all stocks rotate. Some are bargains at other times, some get ahead of themselves. And like right now, we don't really have any recommendations in pipeline and infrastructure because the stocks have done extremely well. Just for example, TransCanada or TRP, the stock low was 43.70 in the last 52 weeks. The high was 55.99. It's 53.06 today. So it's
Mhm.
had a good move, plus the nice dividend yield that you're getting there. But the drillers are cheap. You can buy Ensign Drilling, Total Energy. Total has been at your conference,
Yeah.
waving the flag. Dan Halleck, the CEO there. Then you could go to the frackers, Step and Trican. Those stocks are very cheap, very strong balance sheets. And again, as we go and drill more wells in Northeast BC and in Montney Duvernay, you're going to need bigger fracks, more sand, more powerful equipment. And of course, everybody's moving to the DGB4 so that you're not using diesel fuel, you're using natural gas fired, which of course is better for the environment. So there's a lot of bargains right across the board. And every issue we have now, when we do two a month, we pick out top picks within each of pipeline infrastructure, domestic natural gas, domestic oil, international E&P, and energy service. And last issue that we did, we had four of the five top pick where stocks had backed off. And some of the ones that we started with, like we recommended Paramount, 2 months ago in March, and it was $26. It's 32 today. So
Yeah.
that plus a nice dividend, they're paying 15 cents a month. That's a pretty good attractive total return. And you've seen the same thing happen in many other stocks out there. So I think that people should be deciding, do they want to own via an ETF? Do they want to own a mutual fund? If they're more hands-on, which a lot of the people who are involved in Money Talks and come to the World Outlook, they want to talk to management. We have our conference, Catch the Energy, in October. And Victor this morning informed me that he'll be coming out again, which we're very pleased. He'll be hosting the Money Talks room. And so there's a lot of companies out there that we think that people should be looking at. And we do that right up. Right now, we're spending a lot of time on the Q1 results that are coming out. And we've seen some disappointments, but we've seen a lot of companies that have done very, very well. For example, Step had a record revenues and record quarterly profits in Q1 for the company. That's what you want to do, and then own those companies, because we are still cheap based on historical. There's three valuation metrics: PDP, proved, developed, producing, which is what the bank lends against; proven, which includes non-producing; and then
Yep.
probable. And right now, companies are trading at the PDP, or some are trading below PDP, and at the top of the market, they trade at 2P. So the difference in that gap is like 3 and 4 times. So there's triples and quadruples, even at today's price point. But if you have the price of oil go to 120 or 130, natural gas to $4 or $5, that increases those reserve values. Plus, if they increase production, so we're looking at the opportunity in the sector between now and the end of the decade for 5 and 10 baggers. Which I know you've seen me say I've been cautious at times and cool on the sector. I'm in the camp now that anytime there's a weakness, you buy, because we're looking at 5 baggers plus in many, many names that we cover. And we cover 36 companies. We started in 2017 with 20 companies, and now the team has built it up to 36. And we have 3 or 4 names on the watch list. So we'll probably be adding names during the summer after I finish this, the Q1 cycle review of the companies.
Well, I also want to mention one other thing is that, of course, as you're expanding, you're putting a lot more people involved, all of that kind of stuff. But here's a beauty for the Money Talks audience, because, as I say, you give specific recommendations, every time. But for the Money Talks audience, I'll just make them aware, because it reinforces one of my things about the cost of things going up. And you're finding that out as you hire more people, do more things, expand. So the cost of the Schachter Energy Report is also going up. But this is what my point was. You can avoid that by, if you subscribe to the report, $799 a year, before the end of May, well, you're home free, because you're locked into that price in subsequent years also, as opposed to paying $200 more, going on. Also, you could do it by quarterly too. And we do have a discount, and I'll let you know all that, but the quarterly discount is $50 off that. And I'll put the code out for everyone, because you'll need to enter it to get that, but $75 off the annual fee. But I think, Joseph, again, you're just making my case about inflation, by the way, and people have to take action to not be nailed by everything. But this is a great example. You're saying, look, 7 years, we have not increased our prices. We're going to get killed. We're expanding, so prices go up. So your price of the subscription goes up. But that's what I like. Take action. Avoid that. Do it by the end of the month. And we'll put all those details out for people. But I smiled when I saw that, because, as I say, yeah, that's my inflation story. Protect yourself.
Yeah, and we're seeing it, salaries are going up and the benefits go up. And if you add more personnel, and we want to cover more companies, because our clients, our subscribers ask us to cover more companies. During our webinars, we have a quarterly webinar. We had one on May 9th, and people keep on throwing ideas and say, and if you hear
about this,
and it's worthwhile to spend the time with the research, developing a model, going to see management. And the benefit of our team is we're based in Calgary. The companies are based in Calgary. Having access to management, especially now when most annual general meetings are video meetings, you don't get that face time. So the coming to the World Outlook and the 8 or 9 companies that you guys invite to come, Surge was there, Total was there, a lot of great companies that we like are at your conference. And then at our conference, we have a bigger universe, and we also have clean tech, that we're doing. So, this FaceTime is really an extra value, which is not something that's available all the time. And I think you started it with your conference, and that FaceTime is a very, very valuable access point that if you are involved in a company and you see that they're going to be at the conference, you definitely, as an owner of those shares, want to be able to talk to management.
Just very quickly, if somebody's, again, getting involved, I've always encouraged people, know what your time frame is. Are you a short termer like Victor Adair is, long termer like I am? But what would you? So I know it's a broad question, and we have to know individual circumstances. But generally speaking, if somebody said, "Okay, I'm going to buy in the next dip, and I'm going to look at those recommendations you've got, in the energy report, and uh, take some action," what would be a realistic time frame, though? I mean, would you say, "Look, be prepared to"? There's ups and downs in this business. Be prepared to own them for like 2 years or 3 years.
Well, the energy cycles don't happen very often. We had one in
Mm-hmm.
74 to 81, 99 to 2008, which I talked about at the World Outlook when I've been on the stage. This cycle started in 2020, if you remember March, April, negative oil prices
Yeah.
because of the British hedge funds, shorting it out, shorting the contract, the nearby contract. I think this cycle goes to the end of the decade. So there's going to be ups and downs. And you can look at the price of oil between 99 and '08. It moved, and there were 30-40% swings. You look at any of the stocks that were around in those days, CNQ or Suncor, you're going to see that same kind of swings that occurred there. So we're saying when you see those swings getting to overvalued, stop buying more, hold off, maybe let the dividends accumulate, get some cash reserves. If you're a trader, maybe take some profits. But when those bargain windows come, you want to get to it. And we think the next bargain window could happen in the next couple of months. And when it does, we will be saying again, here's another low cost entry window. Take advantage of that. And I think that anytime you have those bargain pullbacks, you want to get to the position. So decide what you want to own. Are you a conservative investor and you want to own pipeline infrastructure, the big cap energy names with dividends, or do you want to be somewhat more entrepreneurial? Do you want to own a middle sized firm which has a chance to be taken over by the bigger boys, or do you want to be in the service sector or international? But there's a lot of opportunities depending upon your risk profile, your risk tolerance, and your portfolio objectives. And that's why we've been asked by our clients to add more coverages
Yeah.
of different names, and that's what the team is doing to provide. Going from 20 names at the start in April of 2017, we're now at 36, and I think sometime by the end of this year we could be at 40, which I think is our maximum research capacity with the team we have. And that's including an expanded team. So if we want to go up from there, we'd have to add more people.
Well, and people can get more information at schachterenergyreport.ca, but I'm going to spell Schachter for people. Schachter, Schachter, schachterenergyreport.ca. And of course, we'll put that up all on our social media, our email list, all of that kind of stuff too. But in the meantime, Joseph, thanks for finding time for us.
Oh, my pleasure as always, Mike.